Welcome into this week's Research Corner. I'm Senior Analyst Tony Mulvey, joined on the phone by Kevin Hill. Kevin, how are you?
I'm doing good, Tony. Doing good. Ready to talk about the freight markets with you this morning.
Yeah, so last week I was out, but we had a lot of big economic releases. You had retail sales, you've had inflation. Those are the two big headline numbers, right? And you saw retail sales really kind of surprise to the upside. Inflation was a surprise in a bad way. So, you're kind of getting these mixed economic signals. And I really wanted to kind of talk about this week. We worked on a presentation really highlighting some of these macroeconomic trends that we're seeing and what it kind of means for the consumer and then the freight markets. And we'll pull up a first chart here in Sonar, and it's our retail sales chart, and it'll have the CPI also in green. You can kind of see how they kind of track really close to each other. But last week, headline numbers, retail sales up 0.6% month over month in June. But then you had inflation that was up, the CPI up 1.3% month over month, which is a pretty big increase when we hear the stories about inflation peaking. And it doesn't seem like it, and that was a couple months ago, and it doesn't seem like that's necessarily the case yet.
It's not showing up in the numbers yet, I think, because everything's lagged when you're talking about inflation. But going back to June sales, and that we're talking about June, so we're in July. But June sales didn't outpace inflation, and that's something to be expected. I was looking at, I think, the San Francisco Federal Reserve, and they had a really nice chart of the percentage or the portion of inflation that you can blame or show as supply chain constraints. And it was pretty significant. And I think those supply chain constraints are quickly abating, right? But that's not going to show up on lagging data for 60 to 90 days after.
Yeah, for sure. We always talk about this data, and it is always lagging, right? We're talking about what happened in June. It's not what's happening in the economy right now, but it kind of gives you at least an insight into what's kind of going on, but you have to piece it together. And that's where you start looking at what's going on with the consumer credit, and it's surged to the highest levels it's ever been. We'll pull up another chart here, and it's got our consumer credit and then our revolving credit and non-revolving credit. And you see the rate at which we're growing that revolving credit's pretty concerning.
It's very concerning, and it's, the freight and the economic activity that's happening today on July 19th is much different than what the June or the May data that might just be coming in shows. But what we do see is that the inflation, rising prices has an effect on the consumer. And the consumer, the revolving credit, which is credit cards, it's short-term credit. Instead of paying cash, you're paying credit for non-asset things, right? Essentials. That is concerning. And, we talk about peaks and troughs all the time in the research department. And all-time highs and all-time lows usually indicate some type of turning point.
Yeah, for sure. And we've talked about the Hawkish Fed, right? The response that they're taking, they're raising rates at just unprecedented levels. And you're starting to see, what's that do? It causes that cost of borrowing, right? That cost of credit to increase. And even that hasn't hit the consumer yet. So delinquency data still shows that things aren't maybe so bad on terms of credit card, but that's another one of those lagging indicators of what's happening now. People are spending now, and that cost is going to go up. And guess what? If they don't have the money to pay it, they'll go delinquent.
Yeah, you're pulling. Number one, with revolving credit, you're pulling forward demand in some respects. But you're exactly right. When interest rates increase, the value of everything else goes down. When interest rates decrease, the value of everything else goes up, and it just makes money more expensive. If it's more expensive to pay off your credit cards, you're going to buy less, which means less goods. Less goods are going to be moving through the supply chain, which just indicates another indicator for a slowdown.
Yeah, for sure. And it's not just it's not us talking about this. We're seeing it even from, I mean, earnings season's just started. The banks are always those first to report. And we see it from one of the largest bank CEOs, Jamie Dimon. I'll pull up a quote right here. It says, but geopolitical tension, high inflation, waning consumer confidence, the uncertainty about how high rates have to go, and the never-before-seen quantitative tightening and their effects on global liquidity, combined with the war in Ukraine and its harmful effect on global energy and food prices, are very likely to have negative consequences on the global economy sometime down the road. So, I mean, this isn't just isolated to the U.S. It's a global issue, but I mean, the impacts that we're seeing here in the U.S. based on some of these other data points, we're already starting to see the effects, even on some of these lagging indicators.
We are. So, I mean, those lagging indicators are finally catching up to what's happening, what's been happening. And I think it's going to be a little bit, it's going to be more bearish news coming up into the July numbers and the August numbers. And by the time those lagging economic indicators come in, we are going to be, it's going to be officially declared a recession. I think the Atlanta GDP now calculation is 1.2%, which is a little bit better than it was at negative 2.1%. It's now up to negative 1.2%. But if that holds, technically we are in a recession.
Yeah, and I think it's just a matter of time. I think what we're going to see from earnings here in the next over the next couple of weeks is we'll see second quarter that maybe wasn't so bad, where expectations may have been knocked down based on, but I think it's the guidance and the talks about from these management teams of what's to come. I think that's going to be what's important.
I think you're exactly right about that. That's what's going to be important. I think Heartland came out with a record Q2 contract pricing was very strong. So I would imagine that's a very good, especially for trucking, it's going to be a very good quarter. But I'm very interested in see what guidance is for Q3 and Q4. I think that's where all eyes should be, because again, that's a forward indicator and not where we've been, but where we're expected to go.
Perfect. Well, that's all the time we have this week. Kevin, thank you for joining me. But right now, we'll take a quick break and we'll be back with more FreightWaves Now.